What do you think about the incredible drops that we saw in yields around the world? We've seen a little bit of a bounce now, maybe putting in some kind of floor. But the lows that we saw on the 10-year Treasury, 2.2%. We see Bund still yielding negative 16 basis points. What does this tell you?
Tells me that the market is pricing in that the US economy is close to the edge of the cycle, end of the cycle. The Fed will be easing, and therefore, because the Fed is easing, the opportunity for other central banks to tighten is gone, and they'll actually have to be reversing. So it's a race to the bottom globally, really driven by the end of the expansion being forecast in the US, but also the breakdown in trade. Slower trade means slower GDP growth globally.
So you don't see this then as just a dip in yields, a rally to be sold in fixed income. You see us holding at these levels?
We can trade around. I mean, you've looked at the equity open there. That looks entirely characteristic of a dead cat bounce, if I ever saw one. But in fixed income, there's the asymmetry that we've got. We've got the central bank puts, which supports bond markets here. So that's the difference. Equity markets still have significant downside, whereas as the economy frays, whereas for bond markets, they will already price into the forwards, and that's what's happening here. They'll price central bank easing with lower rates and possibly QE in some jurisdictions. So that's why bonds are still able to sustain these kind of valuations. And I think I've said before, Bunds, if we're referring to those, they're trading much more like a commodity now.
We saw yields coming down really throughout this entire equities rally that we've seen in the beginning of 2019. They've been creeping ever lower, even as equities were rocketing up. Does that tell you that the bond market knows more about what to expect in the stock market?
Tells me that stock market valuations can only be justified with extremely easy monetary policy. So the lower discount rate was helping to inflate the equities, and that was really driven by the dovish turn from the Fed at the start of the year. Since then, I think the market has just come to realise that there is still further deceleration of global GDP growth. And the likelihood that this turns into a contraction, some sort of soft landing in the developed economies, is increasing by the day. So I'm not looking at the curve to tell us this. I'm just looking at the economic facts.